Hey, this is Scott Hastings, self-employed mortgage specialist. And today I'm going to do a deep dive into exactly what lenders need from self-employed borrowers. So I'm talking specific guidelines, FHA, conventional, jumbo, etc. So no fluff, really just trying to get exactly what lenders are looking for. So let's do sort of a traditional guideline breakdown. Um, the vanilla loan types, which would be Fannie Mae loans, Freddie Mac loans, these are just conventional 30-year fixed, typically vanilla, fully documented loans. These are, the government-backed loans with the interest rates that you see on the news. So key requirements for self-employed borrowers are going to be a minimum of 2 years of self-employment. Your tax returns are going to have to show stable or increasing income. I'm going to talk a little bit more about that in a minute. We're going to look at the Schedule C for a sole proprietor. So that would be if you only file one tax return, you're self-employed, you don't file a separate tax return as a self-employed person. Or if you do file two tax returns, then we would need the K-1s from your business or partnership. So we would need the full, I'll clarify that, 2 years of full personal and business tax returns. Typically within the business tax return is going to be the K-1. So those are the main things that we need. So the income calculation that we do, and I tell people, it is not how much money you make as a self-employed person, it's how much money you pay tax on. That's the general way to look at it. So we're going to average the last 24 months of income determined by the tax returns. So here's sort of a pro tip. If you've been in business for over 5 years, then typically it's possible to use only the most recent year's tax return. Now, this is not only, the easiest way to tell is if you're an S Corp, for example, or a partnership. On the first page, it's going to say the year that it was incorporated. So we're filming this in 2025. Let's just say on the first page, it says it was formed in 2019. Then you've been in business 5 years. And we could only use the 1 year's most recent tax returns. The reason that comes in handy is because if you've been in business less than 5 years and your income decreased, let's say from 2023's tax return to 2024's tax return, then we could only use the 2024 tax return. So you can only average income when it's increasing from 1 year to the next, not when it's decreasing. The benefit of that, of course, is if you had a much better year, let's say your profit increased a lot from 23 to 24, then we could use just the 24 and not drag down your average income. So if you do have declining income though, let's say you've been in business less than 5 years, then you're pretty much going to have, probably some sort of explanation for that. Usually nothing too bad. When we're looking at tax returns in general, you can add back things like depreciation, depletion, and business use of home. Something that if you are a Schedule C, you only file the one tax return. Something you want to keep in mind also is that you can add back in business mileage. So typically on the first page of the Schedule C, it's going to have a section for business miles. What you would do is you would take the number of miles times the amount that you're allowed to add back for that year. Let's say it's 27 cents per mile. And then you can add that, whatever that adds up to, back to your income. Now, a pro tip, a lot of times I'll talk to people and they'll say, hey, they have a separate corporation, they file two tax returns, and they say, hey, look, I got a W-2 from my company for X amount, so we can just use that W-2. That is not true. The reason is, as a 100% owner of your business or as an owner of the business, you can't pay yourself like a normal employee. So let's say, for example, you pay yourself but then on a W-2, but then also your business showed a loss, it's just not going to work out. So to keep it simple, you can't use your W-2 from your corporation to yourself like an employee of yours would. Now, this is the unfortunate thing, and this is where common sense doesn't come into the mortgage industry. If you have an employee, let's say you opened your business 6 months ago and you've hired a W-2 an employee, they're a W-2 employee. That employee could use that W-2 or their paycheck stubs to go get a fully documented loan. So it's just unfortunate, but that's the way it is. Also, you can go to my website, and I'll put a link in below to a self-employed mortgage calculator that I had put together. What this allows you to do is take your tax returns, plug in the numbers from the different lines that are lined out on the calculator, and figure out your income for yourself. Now, I wouldn't use this as gospel because ultimately you're going to want somebody like myself to review it and do the calculations, but this is going to give you a good idea of where you stand, and it'll give you a good understanding of how your income is calculated. Okay. So you're also going to have, besides the 2 years of tax returns, you're going to have a year-to-date profit and loss statement. So now we're in 2025, you would have to have, well, at the end of January, at least through January 31st, profit and loss statement. And then you're going to have 2 to 3 months of business bank statements as well. So the next type of loan is an FHA loan. FHA loans, again, are typically for people that might have a lower credit score, or they need to use more income to qualify. They need a higher debt to income ratio. Again, you're going to have 2 years of tax returns. That's going to be business and personal, or if you are a Schedule C, just personal, where the business is inside. You're going to have to it's going to have to make sense where your business is. So I'm in North Carolina. That's where I reside. Let's say, for example, somebody is a contractor, and they've been a contractor for many years, but they're moving to North Carolina. Well, it probably doesn't make sense because they don't have an established business in North Carolina to start building houses or what have you. So it does have to make sense. If you work from home, obviously that's a no-brainer. You can work from anywhere. So that's something you have to keep in mind. Again, you're going to have to use 2 years of tax returns. So if your income was declining, then it's just the way it is. You'll have to figure that out. But again, an FHA loan has a higher debt to income ratio requirement, so or tolerance. So that might work out for you. Also, again, you can look at the income calculator on my website, and it's down below for a link for that. You are going to have, again, a year-to-date profit and loss statement as well. So the next is a jumbo loan. Jumbo loan is going to have the most requirements of any type of loan, whether you're a W-2 borrower or self-employed. But you're still going to have definitely 2 years of business and personal tax returns. You're going to have a lot more reserves. So reserves are mortgage payments that you have in the bank after closing. Now, that could be in a 401k, that could be in a bank account, that could be in stocks that you own. But in general, they're going to want to verify that you have the ability to make 12 to 24 months of mortgage payments after closing in case you lose your job or your business gets closed. And also there's lower debt to income ratio requirements. So it's going to take more income to qualify for a jumbo loan. Again, you're going to have the business and personal tax returns. You're going to have the profit and loss statement, year-to-date profit and loss statement. You're going to have a balance sheet. You're probably going to have a business license or a letter from your CPA stating that your business is in good standing. In general, there's just a lot more requirements. Again, you can use that income calculator below if you want to figure out your income for yourself. So what happens when you're self-employed and you can't fully document your income? Or we look at these 2 years of tax returns and you're just not claiming enough income to qualify. This is when we would go to alternative income documentation type loans. So the most popular is a bank statement loan. That's where we would use 12 or 24 months of business bank statements. And depending on what type of business you have, it's going to that's going to determine what percentage of those deposits we can use. Pretty much across the board, you can use at least 50% of the deposits. But if you have a business where you say work from home or you're a consultant, I had a closed loan recently for a client who is a political consultant. She works from home, so we were able to use 70% of the deposits into her bank account. That's how we calculate the income. The credit score requirements are typically going to be a little higher. You're going to probably want to have a 680 credit score. You can go down to a 620 credit score, but it's going to take a lot more down payment and the interest rate is going to be considerably higher. The next thing, let's say, for example, and this is a really good one I've used a lot in the last year, is a 1099 statement. So if you're in a line of work where you receive a 1099 or multiple 1099s at the end of the year, we can use 90% of just the most recent year's 1099 to qualify you. Very straightforward, very easy. The next type of loan would be an asset depletion loan. That would be basically where you have enough income, maybe $1 million, just as an example, where it's clear you have enough money to put down on the home you're buying and make, probably 5 years worth of mortgage payments. So that's a pretty, that's a very good type of loan and makes a lot of sense for somebody that they maybe just left a company and are starting a consulting practice, for example. They have tons of money, but really not a job or haven't worked for very long, 1 to 6 months. So those are just some overview, or that is an overview of exactly what lenders are looking for a self-employed loan. So again, for a fully documented loan, whether that's a conventional loan, Fannie Mae, Freddie Mac, an FHA loan, USDA loan, VA loan, 2 years of tax returns, plus a profit and loss statement. If that doesn't work, then we would look at an alternative income documentation loan, like a bank statement loan, 12 to 24 months of bank statements, a 1099 loan, just use the 1 year of 1099s, an asset depletion loan, or maybe even a no income loan where you don't list any income, but you got to put at least 25% down. So I am going to put a link to that video as well about the no income documentation loan in the comments. If you found this video helpful, it'd be super helpful to me if you would click like and subscribe, and then you'll get notified when I put out more content. So thanks for watching, and look forward to bringing you another video.